Good morning, everyone. My name is Jason Collins, and I'm here with URL Insurance Group. I'm an agent support specialist here at URL, specializing in single premium life products. First off, I'd like to thank everyone for taking the time out of your busy schedule to be with us today. Those of you that are currently doing business with URL, I'd like to personally thank you. We understand that you have many options as to where you place your business. That's why we appreciate you working with URL, and we'll promise to continue our dedication to your success. Some of you are new to the URL family. Welcome. URL is a full-service national broker. We provide agents complete support in all of our lines. URL provides single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers Med Sup and Med Advantage products. So please take a moment after the webinar to tour our website at www.urlinsgroup.com and discover if there are any additional avenues for URL to assist with your success. Again, that website is www.urlinsgroup.com. I'm extremely excited to be part of presenting this great program for you today. Single premium life has been growing in popularity the past few years. People, and more specifically baby boomers, are realizing that they have cash value in old whole life policies that they don't want to continue to pay into anymore. They have money that is set aside and earmarked for the next generation, making little or no interest in CDs or savings account, or have concerns about their future with regards to long-term care. Today, we're going to discuss two brand new options that will help your clients with these concerns. I'm proud to introduce Jason Goodrich. Jason is the Senior Wholesale Manager at Equitrust Life Insurance Company. He's here to review the new single premium life wealth transfer vehicles that Equitrust offers, the Secure Suite Life and Growth Suite Life, and discuss how they will benefit your clients. Before I turn it over to Jason, though, I'd like to mention, should you have any questions during the broadcast, there is a question box on the right side of your screen that you can type them in, and we will answer at the end of the program. So without further ado, I'd like to turn the program over to Jason.
Thank you, Jason. Let me get my screen up here. I apologize.
Did I switch that over to you, Jeff?
I don't have it yet. I haven't seen it yet, Jason. Do you have that to share my screen? It looks like it's still showing yours. There we go. There we go. Okay. Thank you, Jason. Let me get it up here. Good morning, everyone. As Jason said, my name is Jason Goodrich. I'm one of the national account managers here with Equitrust Life Insurance Company. First off, I'd just like to thank everyone for taking time away from your busy schedules this morning to join me for an overview of two exciting and brand new single premium life products from Equitrust Life Insurance Company. I know everyone's very busy and I don't want to take up too much of your time this morning, so I'm going to try to keep the presentation to around 20 or 25 minutes or so, just cover the products and the positioning of the products at a fairly high level. However, as we go through the presentation, as Jason said, if you have any questions, go ahead and type them in the question box, and then I'm happy to address those at the end of the presentation. What I'm going to be covering today is the Secure Suite Life and the Growth Suite Life single premium life products, which we just rolled out a few weeks ago. As you may know, Equitrust has been one of the leaders, if not the leader, in single premium life sales for the last 8 years. And I strongly believe that with these new products, we will continue to be the industry leader in single premium life insurance. And hopefully you'll understand why as we go through these products today. Lastly, let me just thank Jason, Joe, Maria, Cody, all the great folks over at URL Insurance Group. URL has been a top marketing organization with Equitrust since the very beginning for both life and annuity. So that's over 14 years on the annuity side, over 8 years on the life side. They've been with us and been a top partner for Equitrust. So we really appreciate their support and long-term partnership. With that, let's go ahead and get started. Okay, before I Well, to start off here, I just kind of want to give a quick overview of both products, and then I'll get into more of the specifics as we go through it. But as I mentioned, there's two products. The first is what's called the Secure Suite Life. If you're familiar with the Wealth Max bonus with Equitrust, this is kind of similar to that product. And the product's really, the design of it is really guarantees. Okay, so it's going to have a lot of guarantees within the product. It's going to have a guaranteed no lapse death benefit. It's going to have guaranteed cash values like a whole life policy. It's going to have a return of premium after year 4, so it's graded in ROP that we'll talk about. So a lot of guarantees within it. It's going to have guaranteed living benefits, right? Monthly benefits for chronic illness or nursing care. But what we were able to do with the Secure Suite Life product, where WealthMax had kind of fallen off a little bit, was we're able to give a lot higher caps on this product. So although the ROP may be graded and the bonus may be 5%, a little bit smaller, the client's going to benefit from that actually, because they're going to have a lot higher caps and a lot higher growth on it. And on the non-guaranteed side of the illustration, it's going to have a lot more potential than it did before. It's going to have the same commission as the WealthMax. Really kind of the target age, I would say, for the secure product is 60 or 65 to 85. You know, maybe 65 to 85 is kind of the sweet spot for the secure product. Really more of a senior product where they're really looking for guarantees within the single premium life product. On the other product is called the Growth Suite Life. This is a little different than anything out there. This product does not have the guarantees. Okay, so it doesn't have a guaranteed death benefit. So it is possible, if it does not perform, that sometime in the distant future they may have to add money to it. Unlikely, you know, if it performs decently well, but it is a possibility. But what the client's getting in exchange for not having that guarantee is they're getting super high face amounts that we'll talk about. The highest face amounts in the industry for a simplified issue product. They're getting the highest caps in the industry for any product, simplified issue or fully underwritten. High face amounts mean very high living benefits, chronic illness benefits. It's got liquidity through free withdrawals and loans, and a very much higher commission with 11% commission as it is a longer term product. The sweet spot for this is a younger client, whereas the secure is more 65 to 85. The growth, I think, is more 45 to 65 or 70. Is kind of the sweet spot for it. Okay, and we'll talk more about that as we go through. So that's kind of a quick overview. We'll get into a little more detail here in a second. I do want to mention we are running a commission special right now too, and this runs until the end of June for either product. And you can see it on your screen there, but it's we'll pay you $250 additional commission on any cases of $25,000 to $49,999. $500 on any case that's $50,000 to $99,999, and $1,000 for every case you submit of $100,000 or more by the end of June. There is no limit, right? So if you write 5 of these, you get paid on all 5 of them. The only deal is it's only 1 per client, so you can't write 2 on a client and get 2 commission bonuses. Okay, let's get into things a little bit. First off, let's talk a little bit about the positioning of these products, and Jason actually, touched a little bit on that at the beginning. But really, there's 2, maybe 3 key positionings of the single premium life products with Equitrust where they're going to fit. The first one, as you probably all know, is wealth transfer. It's going to be a great fit for any client that has a sum of money, a lump sum of money, that would like to pass that on to their kids, their grandkids, their church, their favorite charity, something like that, for anyone that wants to leave a legacy. Just a quick example here, a 55-year-old has $50,000. That $50,000 immediately turns into a death benefit of $155,286. Right, so obviously if the goal for that $50,000 is to pass it on as a legacy, this makes a lot of sense. It immediately triples the value of that sum of money, and it's tax-free, obviously. So that's obviously the first positioning of it. The second one, and the one we're seeing lots and lots more of over the years, is as an alternative for somebody that has not addressed, the long-term care need. This is not a long-term care rider, and it does not have a long-term care rider on it. We'll talk about that, but it could be an alternative in certain situations. And we'll get into more details in a minute, but same scenario, that $50,000 is going to give them $155,000 plus to help pay for home health care, or if they're in a nursing care or assisted living or adult daycare or something like that. It's going to allow them to have money, presumably tax-free, to help pay for that. So that's kind of the second positioning of it. And the third one I would mention with our growth product is there's really strong long-term cash value growth in the product because of the high caps. So if for some reason they decide they don't want to leave the legacy, or they need some money to, help with retirement or something, it is going to have cash value growth 15, 20 years down the road too. That's going to be very attractive for that younger client. Okay, source of funds. I always like to talk about this, and Jason once again touched on this in the beginning too, but I like to point out where we see the money come from into our single premium life products. The thing is, very rarely do we see replacement type business. So we don't see much annuities coming into the life products, or even much life insurance, although we see a little bit more of that. What we really see is a lot of CD money and liquid account money. So either CDs earning a minimal interest rate, or even more than that, probably is money sitting in a checking account or a savings account or a money market account or maybe a mutual fund that they don't need. They like the security of it being in the bank. These products can be a great fit for that type of money. So if you know clients like that, this could be a great fit for those situations. And I'll talk more about that. But annuities, we do see some annuities. It would be a taxable event moving from the annuity to life insurance, however. But if they have an old annuity where they don't need the money, it could make sense to move into this, create a tax-free death benefit. And lastly, Jason mentioned old life insurance policies. We do see people 1035 exchange cash value of life insurance policies that are not performing, that are blowing up. Maybe they have an old whole life policy that's going to mature at age 95 or something. It could make sense, obviously, to do a 1035 exchange of the cash value into a paid up policy with Equitrust, like the secure product. Underwriting. If you're familiar with the Wealth Max, I do want to point out that the underwriting is has changed a little bit with these two new products, and actually is going to be much more convenient for you and your clients. It is still accept, reject up to table 4, standard to table 4, so we either take it or we don't. The difference is we went through a complete point of sale underwriting process, which means you're going to get the decision on the phone while you're still with your client. Okay, so you're going to know right then. So if for some reason it's going to be a decline case, you're able to pivot right then to a different product or something else at that point without having to come back to the client at a later time. It's very simple. There's some pre-qualification questions on the application. They're also in the agent guide. And the key is the client needs to answer no to all of those questions. Okay, they are knockout questions. So if they answer yes to any of the questions, they would not qualify for this. So do not take the application and look at another option for that client. If they answer no to everything, though, they will qualify for it, assuming there's no information that we find out through a prescription check or an MIB that's going to contradict how they answer those questions. Okay, so if they answer no to everything, you can complete the application and you can do the phone interview. We don't do exams or fluid draws at all. So the phone interview would be you as the advisor or agent initiating the phone call, handing the phone to your client. They'll go through those same knockout questions with your client. At the same time, they'll check the prescription check and the MIB to make sure there's nothing there that's of concern. If there is, they'll ask them about it. Assuming everything's fine there, the client will hand the phone back to you and they'll give you the approval over the phone and you're able to move forward with the case. Okay. If something does come up that's going to cause a decline, they'll give you the decline over the phone. But at least then you'll know and you can move forward with something else. What's nice about this new process is for any case that's under $250,000, we do not do APSs. We do not order medical records. In every case, a decision will be made off of the information. Okay, so you won't have to worry about delays, waiting a month to get an approval or anything like that. So every case below 250, at the end of the call, they'll give a conditional approval. And then, like I said, fax the app in and we'll move forward. If the case is over $250,000 or higher, it's the same process. The difference is we will order an APS in every case of 250 or higher. So they will give a conditional approval at the end, but it'll be subject to an APS review. The app comes into Equitrust, we order an APS, underwriter reviews to make sure everything looks okay, and then you get the final approval. So below 250, no APS, 250 and above, APS on them. And then of course we do the real-time notifications through the email process, also on our website. Also, if you've downloaded our mobile app on your phone, through your Android or your Apple phone, you get push notifications notifying you of the approvals too. So if you haven't downloaded the app on your phone, I encourage you to to go out to your app store and pull the Equitrust app down. It's really nice to get real-time notifications, not only on the underwriting on life insurance, but also on the annuity side, on suitability, on when commissions pay, things like that. So it's a really nice app that gives you real-time notifications. So that's the underwriting. Before I get into the products, let me just also mention liquidity, because I know people are always curious about how liquid these are as life products. I'll talk more about this, but both do offer free withdrawals after the first year. As I mentioned, the Secure Suite Life has a graded return of premium, so it has a return of premium on it. The accelerated death benefit is, obviously a great liquidity option, and the growth product has zero cost loans on it as well too that we'll talk about. So plenty of liquidity options within both products if they do need to access the money. Okay, living benefit rider. As I mentioned at the beginning, this is a key positioning of the product. I would estimate close to 40% of our sales. This is the driving factor in it. For those folks that maybe have not addressed a concern for nursing care need down the road, or home health care need, or assisted living or something like that, this is a great option to address those needs. With our living benefit rider, first off, it's automatically included with the policy at no cost in the states it's approved. It's approved in every state the product's approved, with the exception of Florida, I think. I think every other state it's in, but if you're not sure, you can, we can talk afterwards, I can verify. Excuse me, there's no cost for it. There's a one-time admin fee of $250 if they ever elect it. And there are 3 different triggers that would allow them to accelerate the death benefit and start receiving the payments. First is terminal illness. That'd be 12 months to live, less than 12 months to live. With that, if they qualify, we would just pay them a lump sum of 95% of the death benefit, and that would be tax-free. Okay. Second trigger is the nursing care confinement trigger, 90 consecutive days in a nursing care facility. If they qualify under that, they have the option to either take a lump sum of 85% of the death benefit, or do what most people would do and take 100% of the death benefit, but over 3 years. Okay, so the calculation for that would be whatever their death benefit is at the time that they qualify, we would subtract the fee of $250, right? We would divide that amount by 36 months. Whatever that number is, that's what they're going to be guaranteed to get each month to help pay for the nursing care confinement. Okay, and it does fall within the long-term care guidelines, so as long as they meet those guidelines, it should be tax-free, right? As long as they take it properly and use it properly. The third trigger, and really probably the biggie, the one most people care about, is what we call chronic care. Others call it chronic illness. But what it is just the loss of 2 of 6 activities of daily living for at least 90 consecutive days and expected to be permanent. So 2 of 6 ADLs that's expected to be permanent loss. They do not need to be confined for this. So it's just a loss of 2 of 6. So this could be home health care or something along those lines. With that, they also have the 2 options, 75% of the death benefit in a lump sum, or once again, what most people would do is 100% of the death benefit monthly, but with chronic care, it's done over 5 years. Okay, so the death benefit minus 250 divided by 60 months, that's going to be what the client's guaranteed to receive each and every month for those 5 years, presumably tax-free. If they pass away somewhere in the middle there, or at any time during the payments, whatever is left will be paid in a lump sum tax-free to the beneficiary. So one way or another, they're going to get all that death benefit paid out of that policy. Okay. And one of the advantages I would say of a chronic illness rider compared to maybe like a long-term care rider or something is that a couple of advantages. First off, this is an indemnity plan, right? It's not a reimbursement plan. So if they qualify for the 2 of 6, they don't need to submit receipts to us. It's not a reimbursement type deal. They just show proof to us of the loss. We start cutting checks every month to them. They do whatever they want with it. Okay. The other thing is underwriting. Life insurance, these products are underwritten for mortality, not morbidity. Okay, so they're underwritten as life insurance because it's a life insurance policy. This is not long-term care insurance, as I said. So we don't have all the cognitive testing you might see with a morbidity underwritten type product. As far as cognitive and things like that, obviously they still need to be healthy, and there's questions directed towards that, but not near to the same extent. So I did want to point out those couple of issues and couple advantages to using a chronic illness benefit. Okay, let's jump into the specifics of the products. First off, we'll start with the Secure Suite Life. As I mentioned at the beginning, the sweet spot for this is really the senior market. I'd say 60 or 65 to 85. Okay, this is more of your wealth max type product, lots of guarantees. Issue age is 45 to 85. Minimum premium is 10,000. The maximum is based off face amount of 750. This is a guaranteed death benefit policy, so it has no lapse guaranteed age 121. Has a 10-year declining surrender charge, starting at 12% and reducing. It is an index product with very attractive caps, which give it some nice growth potential. We'll talk about that. Has a premium bonus, 5% up front, so it gives them an immediate bump in their account value, which also gives them an immediate bump in their death benefit for the minimum. I mentioned graded return of premium. Okay, it starts out at 88%, and then it goes up each year, and then after the 4th year, it's 100%. So after 4 years and 1 day, they're guaranteed, worst case scenario, to get all their money back. Likely their cash value is going to be more than the return of premium already at that point with the caps and stuff. But if not, they have that guarantee that after 4 years, they can get their money back, no questions asked. And in addition to that, it does allow loans and also has a 5% penalty-free withdrawal each year after the first year if they want to take that. Okay, so when you compare it to the Wealth Max, for those of you that are familiar with that, the bonus is less and the ROP is graded, but the caps are a lot higher. Okay, so that's the client benefit. They're getting a lot higher growth potential through the caps and the rates. Here's those caps and rates. Fixed accounts 425, the point-to-point S&P is up to 9 now, where it was 6 on the previous product, so a big jump there. 1-year monthly cap, that's your monthly point-to-point, 3% monthly cap on that. Has a monthly average with 100% participation rate and no cap. And then it has the 1-year point-to-point participation account in the Dynamo Index. If you're not familiar with that, that's our Goldman Sachs strategy. It's a vol controls multi-asset strategy. It has a 135% participation rate on that with no cap. And then on the right here, you'll just see what the illustrated rates are based off of your elections of your caps. Commission, obviously that's important. 8% from 45 to 75. Still 7.5 from 76 to 80, and then 5.5 commission from 81 to 85, and we do pay daily commissions. Okay, let's walk through a case scenario, and then I want to show you a couple new supplements we've created to help you in the process. We'll take Linda, non-smoker, age 55, $50,000 in a CD earning 2%. As I mentioned, we see a lot of CD business come over here. Her objective is just to leave this money to her 2 grandkids when she passes on. Her concern is she's not addressed the potential need for nursing care or home health care expenses. And we're going to give her 3 options. Leave the money in the CD, earn 2%, which is a great CD rate. Transfer it into a multi-year guarantee annuity at a 3% guarantee rate, or obviously purchase a secure Sweet Life policy. Let's just take a look at the 3 options. The CD, obviously that's going to be taxable every year, and we just assumed a 28% tax rate here. So that $50,000 at 10 years, if she passes away, is $57,884. At 20 years, it's $67,494. How about that annuity at 3%? Well, as you know, that's going to grow tax deferred, but in most cases, it's going to be taxable at death, assuming they take the death benefit out. At 10 years, that's going to be $62,381, and at 20 years, $79 and some change. And then let's take a look at the guarantee of the Secure Sweet Life. So immediately, whether it's 10 years, whether it's 20 years, whether it's 40 years, the guarantee, if she moves that $50,000 into the Secure Sweet Life, is a death benefit of 107, right? So it over doubles for her. So if her goal is wealth transfer, obviously this makes a ton of sense. And as I mentioned, with the caps, you have some nice growth potential. So you can see, 150 non-guaranteed up to 158 non-guaranteed at 20 years. So the 107 is the guarantee, but there's definitely potential to exceed that if it performs. And if it doesn't, you have the guarantees within it that are very strong. Now let's take a look at if Linda does not pass away, but needs those funds to help pay for nursing care, confinement, or home health care, or terminal. So the guarantee on terminal illness is 101,400. So that $50,000 is over double if she becomes terminally ill and is tax-free. Nursing care confinement. If she goes in a nursing care facility, worst case scenario, $29.65 a month, tax-free for 3 years to pay for a nursing care facility based off that $50,000. Home health care at $17.79 a month for 5 years to pay for that chronic illness. Okay, and those are the guarantees. It could be higher than that because it's based off the current death benefit, not the guaranteed death benefit. I'm just showing you a worst case scenario here. I'll show you what the other side looks like in just a second here. Okay, what I want to show you next is something we recently rolled out, which has actually been received very well. One of the things we're trying to do with these new products is create more sales tools for you guys to help you in the sales process of single premium life insurance. And we're doing that through supplements within our illustration. And we recently rolled out 2 new ones, and we're working on 2 or 3 other new ones that I think are even better and really going to help you when you're meeting with the clients to show the value to them. This is the first one, and this is out there now. It's called the Power of Guarantees, and this prints with every Secure Suite Life illustration you run, okay? And it's all about the guarantees. That is really the driving sales pitch of the product is the guarantees. And this just on one page in a nice format allows you to show your client what the guarantees are, okay, without looking at the numbers in the illustration and stuff. So as you can see for Linda here, that $50,000 single premium, her guarantee return of premium shows $50,000 after 4 years, right? Worst case scenario, she gets it all back. Health-related events, nursing care, her guarantees $29.65 a month. Her guaranteed chronic illness $17.79. Guaranteed terminal illness 101,400. Those numbers I just showed you. It shows right here, and then her guaranteed death benefit, which I showed you, shows right here too at 107. So this is just on one page breaking down the guarantees for her wealth transfer, or her if she needs it for chronic illness or nursing care, or if she needs her money back, it shows that guarantee as well, right? I think guarantee is in this page 9 times. So obviously the point of this is to really spell out this is what's guaranteed to your client. Okay, and like I said, this prints, auto prints every time with every illustration you run for the Secure Suite Life product. However, we also wanted to do kind of a point-in-time snapshot of something similar, okay, to show, so you can show your client what values might look like sometime down the road without looking at the, going through all the minutia of the actual illustration tabular page. So that point in time that we chose for this snapshot is their life expectancy. So it's going to be a different age depending on their age. So in Linda's illustration, her life expectancy for a 55 female is age 87. So this is a snapshot of what these values will look like at age 87 for Linda. This is an optional supplement. So this is not automatically included in your illustration. When you run it, or we run it, or URL runs the illustration, they will have the option to elect this supplement to be added to it. But instead of showing the guarantees, this is going to show the non-guarantees at life expectancy. So in this case, the cash value at age 87 based off the illustrations is $142,198, okay, from that $50,000. The living benefits you can see, $51.20 a month for nursing, over $3,000 for chronic, right? If you remember on the guarantee page, the nursing was $29.65 and the chronic was $17.79. So although the guarantees are strong, you can see the potential of how much higher these actually could be for her to pay for those needs. And then the death benefit, even though the guarantee was 107, at life expectancy, it's projected to be 184,573 based off the illustration. So this just does a good job showing the potential of what it could look like. It's not going to look like what you see on your screen. It's not going to perform exactly like that, but it will give them an idea of the potential of the product within it. Once again, it's an optional illustration or supplement. We've gotten great feedback off of it so far. Okay, let's move on to the Grow Suite Life product. This one's a little different than any single premium life product I'm familiar with out there. On a simplified issue chassis, I think it's been a very attractive product, and actually we've seen the majority of the sales so far come in on the growth product compared to the secure product, which we weren't sure about that, but that's kind of what's happened. The issue age on this is 45 to 80. Once again, I think the sweet spot's more of a 45 to 65 or 70 type sale. Minimum premium's a little higher. It's 25,000. Same maximum though, 750 face. And instead of being 10 years, this is 15 years. Okay. Part of the reason this is a younger age client is its value. There's a lot of immediate value in it, but the real value is more longer term. So it's meant for a kind of a longer term sale. What makes it unique is it has super attractive face amounts, which leads to super attractive chronic illness benefits. As far as I know, it has the highest face amounts on any simplified issue product in the industry at those ages of 45 to 65. I'm not aware of anything that's even really that close to it from a face amount perspective. Rates extremely high, highest caps in the industry, I believe, of anything out there that I've seen. So very high caps. It does not have a bonus. It does not have a return of premium. It does not have the guaranteed death benefit and the guaranteed cash value. In exchange, the client gets the very high face amounts, chronic illness benefit, and strong growth potential within the product. So it's a decision they have to make. If the guarantees are more important, they're gonna go towards the secure product. If they want to maximize things, the growth product is going to be probably what they look at. As I said, there's no ROP, but there's plenty of liquidity within it. It has 10% penalty-free withdrawals after the first year. It also has 0 net cost loans after year 10. So it's a 15-year surrender charge, but beginning in year 11, they can take a loan from it at no charge. Not only that, they can illustrate that at the beginning. So when you run an illustration, if they also want to see what loans might look like at age 65, you can do that if you choose to, just to see. Same with 10% free withdrawals. You can look at those as well too. Okay, so once again, you're giving up the guarantees, getting lots of potential, lots of growth. And just to give you an example, as far as the guarantees and as far as the potential lapse of it, if one example would be a 60-year-old. Let's take a 60-year-old female. On the guaranteed side, so that's worst case scenario, so that's earning 0% every year with maximum cost of insurance. If that happened, it would last for 20 years. It would lapse at age 80. Okay, that's worst case. Obviously, that's never going to happen. If you look at the alternative scale on the illustration, and what that is, it uses current cost of insurance in the fixed rate account. If you look at that, it actually goes 40 years to age 100. So just by using the fixed rate, it carries from age 60 to age 100 before it would lapse. Okay. So it does not take a huge interest rate or growth for it to carry well past life expectancy. And here's the caps on it. I mentioned they're very attractive. 5% on the fixed rate, 13% point-to-point cap. That's the one I'm talking about. That's the highest in the industry, I believe. 120% participation rate on a monthly average. No cap on that. It has a point-to-point on the S&P with a 70% par and no cap. And then our Dynamo, again, which is our Goldman Sachs strategy, 160% participation rate, no cap. Here's your illustrated rates. The highest illustrated rate is a 7.35. Obviously, you don't have to illustrate at that rate. You can illustrate anything below that. If you want to run one up 5 or 6, you can do that easily through our illustration system. Commission, very strong on this because once again, it's a longer term product. 45 to 75, it's 11% commission to you as a writing agent. 76 to 80, we still pay 9% commission. Now, I mentioned the face amounts are really high, so I want to show you some numbers here just to give you an idea of how attractive they actually are. So if you look at that 45-year-old, that's a face amount of 527. 50-year-old's 405. You know, very high for a simplified issue product. 55, 316, 6250, and at 65, it still doubles. The 100,000 still gets them 202,000 death benefit. Excuse me. And once again, what that means when your death benefit's high is your chronic illness and your nursing care benefits are high as well too. So that at age, let's look at that age 50 again. The chronic care benefit's 6476. Nursing care is 11243. To put those numbers in perspective, I believe the average cost nationally of home health care is around $5,500 a month. So that $100,000 for the 50-year-old would cover what the average cost of home health care is. The average cost of nursing care nationally is $8,000 and something. The nurse, you see, it's $11,243, well above that for that $100,000. So it's a great way for that 50-year-old, if they have the lump sum of money, to address that need up front. While they're still young enough to address it. Then I don't have it on here, but the cash value is very strong too. If I just look at the 50-year-old, and let's say at age 70, they decide they just want to take some money out of it, well, you got over $225,000 of cash value in the policy too. Okay, so so kind of 3 options. You know, they can use it to help, you know, do a vacation or something when they retire as well too. Okay, supplements on this. We do not have the guarantee supplement. Because this doesn't have the guarantee, so you're not going to see that supplement print with the illustration that says guaranteed 9 times. But you will see a life expectancy snapshot in this one as well. Same client, Linda here, age 55, put in at age 87. So you can see that $50,000, the death benefit is $258,905 at life expectancy. So it's over $100,000 higher than the initial, and the initial is higher than any product out there on a simplified issue product. So very high death benefit once again, which once again leads to your high living benefits, $71.85 for nursing care, $43.11 for chronic. At issue, based off the initial face amounts, those numbers were $43.06 and $25.83. So potential for large increases from already substantial benefits. And then the cash value, you can see, is $246,576. So that $50,000 has grown what looks like fivefold, basically up to that point for if she wanted to access the cash value of it. Once again, this is an optional supplement. Okay, so when you look at the Growth Suite Life product compared to the Secure, I think there's kind of four key things. First is obviously the accumulation potential from the really high caps and rates on the product. Number two, if they're looking for wealth transfer and they're looking for simplified issue, they're not going to find face amounts this attractive on any other product. Number three, the face amounts that are high lead to the high living benefits that we discussed. And last, although there's no ROP, there is liquidity through free withdrawals, and then loans, and then wash loans in year 11. Okay, just to wrap up here a little bit before I pass back over to Jason, summarize. We are doing point of sale underwriting now, so you as the agent will get the decision why you're with the client with these two new products. We've went to kind of a feature-focused design on the product. The Secure, really more for guarantees, more of a senior client. The Growth, without the guarantees, but a lot higher face amounts and growth potential, and maybe a little bit younger client. And then the living benefit rider on both products is very attractive for those folks that have not addressed that need. Just to close up here real quick, I sort of mentioned our website. The reason I mentioned this is to access most of the stuff on here, you have to be appointed with Equitrust on the life side. So if you're not appointed, call Jason, call URL, get that process going so you have access to the tools we have out there. Mention our company strength. We are B++ rated. As you'll see here, though, the financials are very strong. Our assets are over 18 billion now. RBC, which is our capital ratio, is at 390, which is higher than a lot of A-rated carriers. Very high capital ratio, and then our solvency is over 105, extremely strong. So the financials are very strong. The B++ rating, the goal of the company, without a doubt, is to get the A rating, and we're working towards that every day, and it's just a matter of time. So we'll continue to work towards that. I do want to point you to a piece that we have if you run into rating issues or a client maybe is concerned about the B++. This is a piece we have on our website, and you can also go to the Wards 50 website. And if you're not familiar with Wards 50, what they are is they're a group that has went out and analyzed basically all the life and health insurance companies in the United States, over 700 of them. And they do a 5-year look back at their financials, average return on equity, assets, revenue, growth, all that stuff. They look at over 5 years, and then based off all that information, they pick the top 50 performing companies. And for the last 2 years, Equitrust has been honored as being a member of the Wards 50 as one of those top 50 carriers. I think that says a ton about our financials and who we are as a carrier. Most of the other carriers in there are very large carriers, much larger than us. So we're really pleased to have been awarded that 2 years in a row. And if you go to the Wards 50 website, if you Google that and go out there, there's information out there. There's a client piece out there. We have a piece on our website. You can also see who the other carriers are. There'll be a lot of names you recognize from large carriers. So I do want to point that out. It's a nice piece and a nice honor, and I just wanted to point that out to everybody. With that, that's all I have. I know it's a lot of information, kind of quickly, but I really appreciate everybody joining us today. And with that, I'll pass it over to Jason to see if we have any questions.